Hello, my name's Charles Dynastic. I am the Managing Director of Blue Bond Tax Planning. I've been an inheritance tax specialist for more than 18 years and we have helped hundreds of clients save millions of pounds on their inheritance tax planning. So today's video is around the subject of an employee benefit trust and how it can help people save significant amounts of capital gains tax and also reduce the value of their estate for inheritance tax purposes very, very quickly. So how does an employee benefit trust avoid capital gains tax both on properties and or on investments, but also save inheritance tax very quickly? So an employee benefit trust is often set up for people with property portfolios who've made significant capital gains tax on their properties. Now, CGT has become a serious issue for property landlords since the capital gains tax allowance was reduced in November 22. Now, obviously, this is exactly the same for people who've got significant investment assets. Now, if you sell or gift properties or investments, the capital gains tax will be immediately payable. So how can an employee benefit trust help? So first of all, if you've got properties and you own those properties personally, we will need to set you up a limited liability partnership first because you can't move the properties immediately into a company. So 3 years later, we set up a family investment company. Now watch our videos on family investment companies to understand this first. And then the properties are effectively conveyed in exchange for capital shares. Now these shares are different to the shares of a normal limited company in that they are set up to contain no voting rights or rights to income. Now income is distributed effectively by means of separate class of shares called income shares. Now if you have an existing company, that company must also be converted into an FIC first because you need to have control if you're going to give the shares of the company away to the employee benefit trust. So once the FIC is set up, the capital shares are then passed into the employee benefit trust, which is a specialist type of discretionary trust which must have a sponsoring employer. Now the employees of the company, who are also the beneficiaries of the trust, should only be family bloodline, in other words your children and grandchildren, and they must be paid a small monthly salary. Of course it can be whoever you want it to be if you don't have children, nephews, nieces, brothers, sisters, whatever, but you need those people to be employees of the company. Generally non-family members must not be employees because all the employees have to benefit from the employee benefit trust. If other employees are required to manage, say, a large portfolio of assets, then a separate servicing company should be set up to employ those people, and then that company invoices the family investment company for salaries and costs. So the employee benefit trust achieves a number of immediate benefits. So the shares pass into the EBT and they are outside of your estate immediately. So literally the day the shares get transferred, it's outside of your estate. That means there's no 7-year period. So for people who already have existing companies, this can be done really, really quickly. And, within a month, frankly, after discussions, you can reduce the value of your estate significantly. Now, the other major benefit is there is no CGT to pay because we claim holdover relief, as is an option in any discretionary trust. Now with holdover relief, this means that the capital gains tax is not wiped out, it's simply deferred into the trust, so it's not lost. Now, as I said, the beneficiaries of the EBT are usually your children and adult grandchildren. They must be employees of the company. However, when the original settlers of the trust die, all the CGT dies with them. So there's another major benefit. So at that point, on the death of the original shareholders, a few other things can happen. As the CGT has already been wiped out, the EBT can then pass the shares of the company back to the company employees, who are usually your children and or adult grandchildren. So your children can then set up their own EBT and put those capital shares back in, and if they've accumulated growth in the company and they want to solve their own IHT problem, they could of course put growth shares into that EBT at the time. It's also if they feel that the 125-year length of the trust is insufficient for your grandchildren or whatever reason. So they can set up a new EBT because we've wiped out all the original capital gains tax. Now, an employee benefit trust, due to the huge amount of capital gains tax it can save within existing companies and the immediate inheritance tax benefits, are very useful for professional landlords to avoid CGT and IHT, people who own existing companies where they built up a large investment cash portfolio, possibly in a trading company, and we can restructure that company to separate it out, and then the investment part becomes another company which we can then put into an EBT. People who also want to move high values of assets outside of their estates without waiting the normal 7 years. So very, very useful vehicle, not exactly cheap to set up. It's going to cost over £10,000. Therefore, you need to understand that going in. However, it can save hundreds and possibly even millions in capital gains tax and inheritance tax. They are quite complex vehicles, and therefore they carry various restrictions which you have to adhere to, otherwise they will fail, and therefore experienced advice must be taken. We can help you in this if you have these issues, so please call us if you feel that's an issue for you. Thanks, and bye for now. Bye.